Hello, everyone. Welcome to another edition of Inside Investing, the show that helps you level up your financial knowledge and sharpen your investing skills. I'm your host, Megan Henricks. Have you ever played a game of broken telephone? For those who aren't familiar, it goes like this: the first person in line whispers a message to the person beside them. Then that person whispers it to the person next to them in line, and so on. The goal is that the last person in line can accurately receive the message. Spoiler alert, that often doesn't happen. Somewhere along the line, the message gets distorted. Well, there's a similar phenomenon with investing knowledge. Sometimes a savvy observation or fact gets relayed to investors, but the message somehow gets inaccurately reproduced or misapplied. Pretty soon, what was once a pearl of wisdom can turn into a full blown myth or misconception. That can make it difficult for investors to avoid potential pitfalls when investing or discourage them from starting altogether. So, we're going to bust some of the common investing myths out there with some help from today's guest speaker. Joining us is Charles Edgar Martin, Senior Portfolio Manager at TD Wealth. Charles, it's wonderful to have you back with us.
It's great to be here, Megan.
So, Charles, you work with investors of all types in your day to day work. How often would you say you have to debunk investing myths and misconceptions with your clients?
I think that's a big part of my job, actually. I used to, before I got into this business, I thought that it would really be a lot of analysis and calculating and so on. But the longer I work in the industry, the more I realize that the psychological side to investing is a huge part. So I mean, I just had a portfolio review with some clients this morning, and I spent a good 15 minutes debunking some ideas that they had, which I feel were not leading them in the right direction. So it's an everyday thing.
So, in your experience, do you find that after having conversations with them about like deconstructing the myths and everything, are they more able to stay the plan to be able to achieve their financial goals?
I think education is a big part of it. Bad times are normal. They do come regularly. Recessions are not weird things that happen, once in a lifetime. They happened on average, about every 7 years or so. So I think once you're aware of that and you know that it's normal, it makes you a little bit more calm when it happens. So definitely deconstructing myths that are out there and understanding how we are susceptible to falling for them is the first step. Education is really, really big for investors to succeed.
Okay, that's great news because then we'll be able to help anyone who's watching this webinar to be able to be better investors and be able to detangle some of these myths. So let's maybe start with our first myth that we'll tackle together, which is that an investor has to be debt free before they can consider investing. Why is that not necessarily the case?
Let me tackle this on a rational basis, okay? I am just doing numbers on a spreadsheet. Um, and if I look at debt as I've got, let's say, a mortgage, which costs me, let's say it's 5%, just to pick a round number. So it costs me 5%, or I have an investment portfolio, which I think could make me 7%. Well, mathematically or rationally, I am better taking whatever money I have and placing it at 7% instead of placing it in something to avoid paying 5%. Basically, you look at which is the higher rate of return. Now, we can't be as mathematical as I just said, because both of those numbers will move around, right? My mortgage might be 5% now, but if it's a fixed rate mortgage, at one point that mortgage will come due and the rate will change. And the expected rate of return on my portfolio, well, it's just an expectation, right? In the end, I have found that the people that are trying or living with that myth that being debt free before investing, they're conscientious people. They're the people that are good savers, that are very careful about their spending. They live below their means in general. So they're doing, a good thing. or trying to do a good thing. And I think that they should be more aware about what might optimize their situation. And sometimes, depending on where the costs on those debts are and the expected rate of return, sometimes it's better to be putting some of your money in investments and foregoing paying down that debt aggressively.
But how can an investor figure out whether they should be paying down debt or invest?
So technically, what I would do is I would take all the different types of debt that I have. Let's say credit card. Let's say I've got a mortgage, which part of it is variable rate and part of it is a fixed rate. I put one line for each of those. Credit card, then I would put beside the credit card, I would have the cost of the debt. Let's say it's 20%. And I would rank these things by the percentage. I would probably prioritize putting money towards the things that have the highest rate of return or cost, the highest interest rate attached to them. A lot of the times, the answer is not all one or all the other, right? It's probably sure pay down that credit card right away. But after that, the others are all kind of moving around. And the optimal solution, again, that myth of it's got to be all pay the debt, don't invest at all. I think that's pretty harsh. A lot of times the answer is, you know what, pay down part of the debt, the most costly part of it, and put part of your excess money into building an investment portfolio. And oftentimes that you'll see a better outcome many years down the road by doing that kind of thing.
No, that's good to know because I think sometimes we want like a simple rule, like pay off debt first, then invest, or X amount goes to investment, Y amount goes to debt. But the reality is, because markets change and the situation changes, it is important to be flexible and be able to adjust to what's happening. Okay, let's move on to myth number two, that investing is inherently high risk and that keeping money in a savings account is the safer approach. How might this mentality actually increase an individual's chances of losing money over time?
The people who are susceptible to this myth are really not understanding the dangers of how inflation can eat away at your money. And inflation is, as you may know, is the cost of all the goods and services that we consume going up year after year. And there have been periods where inflation is really high, like when I was really young in the 70s, and there's the more recent situation where we've had in the last year or so, where inflation's been about 5 to 10%, where the costs of things go up quite a bit. Well, if your money is in the bank, it's not going up. Or if it's in a savings account, it's going up typically at a rate which is much lower to inflation. So if your investments are not keeping up with inflation, they're actually going down. So when you take a look at the rate of return on a savings account, net of inflation and tax for people that are taxable, there's not much left over. You are not keeping up with inflation. Your money's actually going down. So it's actually a guaranteed way of losing money or losing purchasing power over time. So that's not very prudent. So what could you do? If you want to have a positive rate of return after tax and inflation, I think you have to consider moving away from the mattress, from the savings account, and from pure fixed income. And I think you have to consider stocks or real estate, which are taxed at lower rates, first of all, and have, in many cases, higher expected rates of return. And history has shown are able to give you a positive rate of return net of tax and inflation.
So I know a lot of people who are not that comfortable with taking a lot of risk when it comes to investing, like you had mentioned, taking it out of their mattress and whether it's putting it in their savings account or whatnot. What can we tell them to kind of convince them to be able to take on more risk to be able to beat inflation over time so that their money doesn't lose more value than it needs to?
It's quite a problem, Megan. And because, I mean, I perceive prudence to be a virtue. So you're trying to tell people that their virtue is actually not helping them. It kind of goes against everything they've been brought up to believe, right? So I think education is a big part of it, quite frankly. If I invested in stocks and I didn't really know how stocks worked, but someone said, well, you're going to make more money, and then a recession hits and they drop 35%, I think I would freak out, right? And rightly so. So if someone told me, look, when there are recessions, very often stock markets, even the best of companies, will go down about 35%. And by the way, recessions happen every 7 years or so. And there are some periods where the market gets nervous and thinks there might be a recession, and stocks will drop 15, 20%. And that's normal. And when you put all these periods, the good and the bad years together over a 10 or 20-year period, you will have made on average in the past about this rate of return, which is higher than what you're doing now. I think if I knew this as an investor who was extremely prudent before investing, and then I invest, the recession comes, it's less scary for me because I know that this is the kind of thing that's supposed to happen. Not all equities are the same either, right? You've got blue chip type equities, and then you've got penny stocks or extremely volatile companies that are, basically rolling the die and trying to strike it rich. Well, those are very different types of companies than big solid companies that are necessary in society. So buying an index fund or ETF of the S&P 500 or the S&P TSX Composite, which are the two indices which broadly represent the Canadian and the U.S. Economies, I think that's a more natural step. And then you also don't have to necessarily consider all the intricacies of like one stock versus another. There you're buying into a big diversified basket. And the more diversified you are, the more moving parts you have that move at different times. So when you look at the overall basket, it tends to, when one is going down, maybe one is going up. So it smooths out that volatility. Um, Another approach which I love, and anyone who listens to me always hears me talking about dollar cost averaging. It's really one of the simplest strategies in the world, but I believe it is really a great approach. So dollar cost averaging basically means figure out how much you're going to save per year. Let's say you're going to save 12,000 a year. Put $1,000 into the basket of investments that you've chosen. Let's say it's an index fund that replicates the Canadian stock market for half of it, and an index fund which replicates the US stock market, where you would put $500 automatically on the 15th of every month into each of those investments. And when stocks actually go down, which they will, right? When there's a recession or some kind of nervousness in the stock markets, you can comfort yourself in knowing that you're buying things on sale. You almost pull for those down months because you're going to be improving your rate of return outcome most likely when you're buying in at those lower costs. And no one needs to be cheered up when things go up. When things go up, you'll feel good anyway. So not only psychologically is dollar cost averaging a good way to do it. I think it'll keep you on a more even keel and less likely to make rash decisions. I think these things, once you know them and you start taking action, they make you a lot more comfortable with what you're doing and a lot more, let's say, able to tolerate the negative outcomes which may come from time to time.
So, you mentioned earlier how sometimes what can be beneficial is adjusting to add some equities into your portfolio. So, this actually brings up what a lot of investors have heard, which is higher risk, higher return. So, our third myth is that higher risk always leads to higher return. What's the faulty logic there?
Well, I can tell you, having managed people's money for almost 29 years now, um, so many people, remember that higher risk, higher return. So let's just really gamble.
Yeah, let's go
Um,
all in.
yeah, let's go all in, right? Go to Vegas, and it's true that if you put like red nine, all my money on that. If you win, you'll make a lot of money, but you will most likely lose every penny that you put down. Higher risk in the stock market doesn't necessarily mean higher rate of return. It means if it works, yes, higher rate of return, but most likely it will not work because it's higher risk. A lot of people don't even understand the risk they're taking. So if you are buying individual stocks, you really should be looking at the financials of those companies. If the company is not making money, well, companies can't lose money forever. If they're not making money and they keep going that way, they will go bankrupt. Not might, will. So you have to know, first of all, is the company profitable? What is the product? So I think there's some homework to be done.
So, how can investors get a better understanding of whether they're being fairly compensated for risk than they're taking in an investment?
As far as being fairly compensated for risk, I would say be very weary about when everyone is buying the same thing that you are buying. There's a good chance that the price you're paying is too high, which means that you are not being compensated for the risk you're taking. Now, the converse is true also, right? So I would say one of the very simple ways to look at valuation is where am I? Am I following the crowd or am I going against the crowd? In general, if I'm following the crowd, most likely outcome is that I'm being undercompensated for the risk that I am taking, and my expected rate of return is lower than it would be if I were going against the crowd. So it's in general. It's again very general strategy or way of looking at things, but I think that it's actually extremely valuable. And I could give you many anecdotes in the past of sectors that everyone wanted to buy and just turned out to be terrible, and it was basically this concept. Um, the other thing, if we want to get more technical about it, is we talked about earlier. You're buying a company, you should know the financials, right? Notice I said buying a company, I didn't say buying a stock. It's the same thing. But for some reason, when people buy a stock, they don't think they're buying a company. And they buy it on all kinds of weird things like the stock went down, therefore it's going to go up, or it's averaged this price. And in the last 6 months, I don't really see the relevance in that kind of stuff. But let's say there's a company, the stock is at $10. So I want to know the earnings or the profits of the company. Well, if the company is making $1 of profits, then very simply I could say, well, $1 of profit, I'm going to pay $10 if I buy it. 1 divided by 10, that's 10%. So my expected rate of return is 10% if I buy this company. That's for year one, right? What are the expected earnings for the future? So I would like the one, if I knew the $1 or if I felt with, using conservative assumptions and analysis that the $1 could keep up with inflation. Well, that's pretty good. So now I'm going to make 10% and it's going to keep up with inflation. That sounds like a pretty decent investment. Let's say the other investment I could buy, the price is lower, so it must be cheaper. It's $5, right? But let's say the profits are 25 cents. That company is actually more expensive, right? Because the 25 cents divided by the $5 is an inferior rate of return than the $1 divided by the $10. So the price of the stock is meaningless. It's really the ratio between those profits and the price. You want to look at the balance sheet to see what the level of debt that this company is taking on. You want to have an idea of how the future of those profits will go through analysis. And those are the ways that you look at things.
And just as a quick reminder to our audience, Charles and I discussed some of the financial metrics he uses to find investing opportunities in his last appearance on our show. So check it out in the Learning Center on Webbroker or on TD's YouTube channel if you'd like to hear more. All right. The fourth investing myth on your list is that the more investments an investor holds, the more diversified their portfolio must be. Why might that not necessarily be true?
A lot of people were investing in the Nasdaq uh, uh, index fund earlier in my career in around the year 2000, thinking, there are many companies in this and they're, all shapes and sorts and sizes. I'm pretty well diversified, but the NASDAQ index was heavily exposed to one sector at the time, which was technology. There are very long periods where one sector can do poorly, um, where the broad market might do really well. I believe the Nasdaq took something like 17 years to break even, something like that. Whereas if you had invested in the S&P 500, which is a broader representation of the U.S. economy, at the same period, you would have had a very different outcome. So the number of companies is definitely, the more companies you own, the more diversified you are. But I wouldn't I wouldn't want people to think that if you have 100 companies, you have a very diversified portfolio. You would want to take into consideration size of companies. You would want to take into consideration geography, different sectors. There are many things to take into consideration to have what people consider a diversified or smoother performing portfolio.
So, how can an investor better understand if an investment will improve the diversification of their portfolio or if it would be redundant?
So, I mean, mathematically, we look at correlations. So you could calculate the correlations. Most people won't be doing that, but you could just eyeball it by taking a 20-year chart of investment A, 20-year chart of investment B, and looking, do they behave the same way? When one goes down, does the other go down? That's the first thing. And when one goes up, does the other go up? If they do, then that's not doesn't mean they're bad investments. It just means you have less diversification benefits than something that would go up while the other goes down, right? Because if you have half your money in something that goes up 10% and the other half in something that goes down 10%, you make zero. Whereas if you have half your money in two things that go down 10%, you're going to go down 10%, right? So you're looking for a low correlation to have the benefits of diversification.
Okay, Charles, we're at our fifth and final investing misconception that we'll cover today, which, as I was prepping for this webinar, there was a bit of a debate in the house about this one. So help us. So it is that timing the market is an effective investing strategy. So, how can timing the market actually curb returns over the long run?
Well, it would be a great thing to be able to buy low and sell high and to do this on a consistent basis. Unfortunately, I have been doing this 29 years or so, and I don't know the tools that will allow you to buy low and sell high on a consistent basis. As a matter of fact, I've seen so many people make this mistake, and oftentimes it's more nuanced. I do know some people who have basically sold everything, then bought back, and those situations don't usually end up turning out very good at all. They The results I've seen are really quite horrible. Um, but often it's more nuanced. It's something like, I've got my portfolio and I want to save 12,000 a year, right? But I'm not going to buy now because let's say it's beginning of 2022. You know, I'm no fool. I do a lot of reading. Everyone knows there's a recession coming. Uh, I'm due to put my 12,000, but I'm going to wait till the recession comes because when the recession comes, the stock market's going to go down a lot, and that's when I'm going to put my money in. I myself, as a young investor, made the mistake of doing exactly what I described. My savings for the year were it was time to do it, and I'd say, well, it's not a good time. I'm going to wait a bit because I think if I wait a few months, I'm going to get in at a great price, and that great price would never come. I have observed. I have a couple of hundred families that I manage money for, and over the years, I've managed money for several hundred families. And I have observed that the ones that keep it simple, that do not try to time the market, in my experience, have done really well. And the ones that have tried to time the market, in my experience, have not done as well. So, I think you have to resist that urge to believe that you have this special skill and that allows you to time the market, which I don't know many people, I don't know any people who have this skill.
I think part of the problem is that we only hear about it when they're doing well, but like you said, it's difficult to be able to do it consistently over the long term. So that brings us to how some investors might feel as though, like you mentioned this, that they should wait until things settle down after a major decline before investing. But how might that hinder their potential returns?
So let's go back to supply demand. Everyone knows there's going to be a recession. So the demand for stocks is very low. So stocks are at a low price. Now your plan is to buy back when things settle down, which means the economy is doing really well and everyone's projecting for things to get better. So for that to happen, you need some history behind you of things going well. So now the demand for stocks has risen quite a bit and the expectations are very much better than they were. Do you think you're buying at the same price that you sold at when things were uncertain, at a lower price than when things were uncertain, or at a higher price? The logical answer is you're buying back at a higher price. So when you sell in moments of uncertainty, and the plan is to buy back in moments of more optimism, well, that strategy is actually saying, I will sell low and buy high, and your strategy is going to guarantee you a loss, right? Dollar cost averaging is beautiful. You buy at all times, right? Because we can't figure out where the market's going to be in 3 months, 6 months, or a year. But you will be buying when periods of uncertainty exist and your prices are probably good. Yes, sometimes you'll be buying too high, but you'll most likely be buying in that period where you would be least likely to buy, which is where your expected rate of return actually skyrockets when you're buying at those periods where no one wants to buy stocks.
So, what are some ways an investor can stay strong through those ups and downs of the market and resist the temptation to time the market?
Knowing how stocks have behaved in the past is very helpful to understanding what's happening, especially in bad periods. I shouldn't say especially, but let's take that example. In bad periods like the recession, you'll be bombarded with information about how this is an abnormally bad period and will never recover. Um, so knowing that they say that every time, and that in the past we've recovered, I think calms us down a little bit, makes us more confident as investors. I think the 2000 and 2008 drawdowns or declines in stocks in the S&P 500, I believe they were the second and third worst in history. So it's good to see what does that look like, right? What if I put all my money in 2007, then we went through that great financial recession, which was a really deep, scary recession, and again the second biggest drawdown, I believe, in history in the U.S. stock market. Well, how would that have affected me if I put all my money in 2007 and I didn't do anything? I think if you looked at the rate of return, if you didn't do anything, you'd be pleasantly surprised to see that you actually made okay rate of return. Now, it didn't look very good a year or so into the investment. There was actually, like I said, a very big drop. But if you didn't panic, and again, if you had that dollar cost averaging, boy, those dollars that you were investing in 2008 and 2009 became very profitable over the future. But I think on the other side too, it's important, right? When there's been a mania and things have gone incredibly well for really long, and everyone's saying, you know what, buying bonds is just foolish. We should put all our money in stocks. And by the way, there's one sector that's really crazy and it does so much better, and we should put all our money in that sector. And instead of having 100 companies in the sector, why not just pick the one or two best ones? You know, typically when things have been going well for a really long time, investors in general become they take too much risk, if I can say that. So knowing that those bubbles have happened in the past, and knowing how they've popped and how your rate of return would have been really affected negatively, gives you an idea the next time a mania will happen, a bubble will inflate, because it will happen again. These things, history repeats itself very often in investments. But knowing what that looks like and how dangerous it is and how it felt like in the past makes you less susceptible to falling to that temptation, I think.
We're going to have to leave it here. But Charles, thank you so much for helping us bust some of these common investing myths out there. Any final thoughts you'd like to share with our viewers?
I think education. I've gone back on it a lot, but reading a lot, informing yourself about how markets work and how to build proper portfolios is really the key.
Thank you again for joining us. And for those in our audience, make sure to register for our upcoming live webinars and check out our library of on demand content available in the Learning Center and on our YouTube page. See you all next time.